Today is Monday, February the 10th, and this is the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. Today's guests are Mark Soderberg, ADMIS Senior Ag Analyst Alan Bush, ADMIS Senior Financial Economist, and Mark Bowman, ADMIS Senior Global Market Analyst. Starting with the grain markets this morning, Mark, what are your expectations of tomorrow's USDA WASDE reports?
Well, I see no changes in ending stocks for either corn or wheat, saying 1.45 billion and 798 million bushels, respectively. In corn, the average trade guess is looking for about a 15 to 20 million bushel drop in stocks. I think a case could be made for higher exports. However, the USDA surprisingly lowered their export forecast last month, so I think it would be pretty unusual for them to flip around and raise it again this month. And beans, I see ending stocks falling about 10 million bushels to 370 million. This due to higher crush. I went back and looked to see if there's some historical tendencies that could be found. And since 2010, corn stocks have actually dropped 10 times in the month of February. They were up only 3 times, while unchanged twice. Price reaction, however, told a different story. Despite stocks being down most of these years, spot prices were also down 10 out of the last 15 years on report day, that for the spot contract. In beans, a similar story on stocks. They fell 7 times out of the last 15. They were unchanged 4 times, and they were up 4 times. Prices, however, they have closed higher on report day in the last 7 years and 9 of the last 15. In wheat, it's pretty much a 50-50 proposition on both stocks and the market's price reaction. And in South America, I just look for slightly lower production in Argentina on both their corn and soybean production forecasts. In Brazil, I look for about a 2 to 3 million bushel increase on their soybean production. I look for corn to hold steady, but I think a case could be made for lower production there. I think the USDA will hold off one more month, however.
And Mark, we frequently look at the commitment of traders reports. Why should traders be paying attention to what the index funds are doing in the ag space?
Well, index funds, they have been net buyers across the ag space now for the last 6 weeks and 9 out of the past 10. Their holdings hit a cyclical low back in the middle part of August this past summer and have since swelled almost 47% to 1.275 million contracts. And now that is their largest holdings since the spring of 2022. So what has triggered this avalanche of buying? Well, recall index funds, these tools are often used by asset managers as a hedge against inflation. So since late in the summer, when the Trump administration started to pull ahead in some of these, most of these major polls, I think inflationary concerns have started to accelerate. While inflation is still well off its cyclical peak of over 9% from almost 3 years ago, it's still yet to reach that 2% Fed target. As a result, Fed easing for now is on hold. And I think it's starting to have a bullish impact on the ag space when we start looking at the threat of tariffs and the fact that could start to reignite this inflation. So it's been bullish in the ag space, including the livestock, despite what's likely to be record production here in the soybeans in South America. It's also caused these spreads to widen out as these funds build. They have to roll these forward leading up to first notice day just to make sure they avoid taking delivery.
Alan, looking at the financials this morning, how will the proposed tariffs affect financial and metals futures markets?
Okay, well, first of all, it does appear that the tariff rhetoric is being ramped up, and it is having quite the impact. So these ramped up tariff initiatives are bullish for the U.S. dollar, since they are viewed to be inflationary, as Mark mentioned, and I think that is very much the case. So this could limit the Fed's flexibility in becoming more accommodative. In fact, it now looks like the Fed is on track to lower interest rates only one time this year, and that would be at the June 18th policy meeting. Just a few weeks ago, there was a probability that the Fed could cut a second time in either the October or December meetings, but that seems to be off the table for now. So only one rate cut, I think, for this year. And that should be supportive to the dollar index. Also, we are seeing the precious metals advancing. The gold futures taking out record highs. So a new record high today, silver is higher. So normally you would think that higher interest rates would be a bearish factor for gold, which is the case. But it's not just the Fed that we have to keep an eye on. Other central banks are likely to be more accommodative, and that is supportive to the precious metals, especially the gold market. And of course, there's the flight to quality influence. So the gold market will probably continue to advance. As far as the interest rate futures markets, a less accommodative Fed puts pressure on futures at the front end of the curve. So I would expect additional weakness there. So futures at the short end will probably continue to work lower. And in the stock index futures, so even though the Fed may be slow to cut, other central banks will be aggressively cutting. So that is a supportive factor for stock index futures. Plus, stock index futures advancing at a time when you would normally not expect them to, with all of these heightened concerns about trade war. So the fact that stock index futures can hold up well suggests that there is probably an uptrend coming, and will probably, I would expect higher prices for stock indices.
Alan, key reports this week. What are traders looking for?
Okay, actually, we have quite a bit on Tuesday and Wednesday. We'll have Fed Chair Powell delivering his semi-annual testimony before Congress. Both of those testimonies will take place at 9 o'clock. Then on Wednesday, we'll have the January Producer Price Index guessed at up 0.3%. And then the Consumer Price Index also this week expected to be up 0.2%.
Thank you. Mark Bowman, natural gas has staged a decent rally off its January 31st lows, but it has only recovered about half of its losses from the 26-month high on January 16th. What factors do you see affecting the market going forward?
Well, there's this potential for strong export demand and then our lingering winter here in the U.S. Reuters this week reported that at least 3 vessels carrying LNG from Oman and Australia were heading west for delivery, with one sailing through the Red Sea. High prices in Europe are drawing more supplies, but it's also they've been drawing supplies from the U.S. as well. Also, Asian spot prices hitting a 2-month high last week, kind of tracking the rally for European prices, even though they have some healthy inventories. And then you add also the chairman of GAIL India said that their company, they were looking to buy a stake in a U.S. LNG plant to secure long-term supply. Now that the Trump administration has lifted the ban on new export permits for new LNG export terminals. India is the world's 4th largest LNG importer, and they're looking to increase their share to a mix of 15% by 2030 from 6.2% currently. So we have this movement towards more natural gas consumption around the world, and the U.S. being the leading exporter in the world and looking to expand further as long as it can develop more export terminals, and that seems to be happening. Meantime, U.S. storage falling. It was down last week. It was fell last week again. Now we're down 7% from a year ago and almost 3% below the 5-year average. And this has happened over the last few weeks, and this has been a major change. This was the biggest deficit a year ago since end of 2022. And a year ago, or even last summer, we were at a large surplus. It's been expected to come down because they lowered production in the U.S. Last summer in reaction to weak prices. But now that the declines are accelerating more or less, and we have this colder than normal temperatures seem to be dominating the lower or the northern half of the lower 48 over the next 6 to 10 days. Some extreme cold temperatures maybe in the upper Midwest and New England, and also 8 to 14 day less extreme, but still showing colder than normal through the eastern 2/3 of the U.S. And so that would probably keep the seasonal drawdown running strong and put us in a position to rally further and maybe approach the January high.
And Mark, cocoa prices fell to their lowest level since December last week. What's pressuring this market?
Well, one thing is the rains in West Africa. They're coming off their dry season. They had a very dry season this year, which was one of the things behind this rally into late December, raising concerns that this year's production is just going to fall short of last year, and therefore keep the deficit a year ago going that we've had for the last 3 years. But rains seem to be on a normal pace. They're starting to show up further inland, and the World Weather Service saying most models say we could see additional rain periodically over the next 10 days, which offers a relief to growers. Last week, there was also, we had a survey of traders and analysts both calling for a balanced market for 24-25 after 3 seasons of global deficits. And this does contrast with all this talk recently about a 4th deficit in a row. The Ivory Coast output reaching 1.8 million tons versus 1.75 for last year. But Ghana's recovering quite a bit to 620,000 from 450,000. Those are the world's 2 largest producers. A first official estimate for 24-25, ICCO will release it at the end of the month.
Thank you all. Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. If you'd like more information about our brokerage services, like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.